This course gives you a comprehensive overview of how to prepare an income statement, the financial document that reflects a company's revenue and expenses. The ultimate purpose of an income statement is to show whether a company made or lost money during the accounting period. In this course, getting started with an income statement, you learn the difference between setting up the income statement in a single-step format and setting it up in a multiple-step format. You also discover how the type of business causes the presentation of the income statement to change slightly. We introduce each section commonly found on the income statement, and we discuss unusual items that sometimes show up. Finally, the income statement in all its glory is laid out on the table, from the entree gross revenues to the dessert net income after taxes. You can break every business into one of three types: service, manufacturing, and merchandising. It's important to realize which type you are working with when reviewing or creating any financial statement, including the income statement. That's because not every type of account shows up on the financial statements for every company. Number 1. Providing a service, when the true value of what a business provides derives from any type of personal service rather than a tangible product, that business is a service type. Accountants, attorneys, physicians, and hairstylists are examples of people who run service businesses. One major tip-off that a company is a service type is if it doesn't have any appreciable inventory. Most service-type companies make purchases only for the job at hand, so they won't carry an inventory. The purchases are expensed to each job. If the company does retain some purchases, the amount is inconsequential, especially when compared to a merchandising company, which sells products another company makes, or a manufacturing company, which makes the products it sells. Number 2. Merchandising to the public. A merchandiser is a retail business like Target or Sears or your local grocery store. The business purchases goods from a manufacturer and in turn sells them to the end user, a consumer like you or me. Unlike a service business, the merchandiser has an inventory. The inventory consists of goods available for sale, which are ready to be stocked on the shelves of the store. So your local grocery store's inventory includes milk, canned goods, baked goods, and so on. Number 3. Manufacturing a product. The finished goods sold by merchandisers have to come from somewhere, and that somewhere is the manufacturer. Because the manufacturer makes products from scratch, accounting for this type of inventory is much more complicated than accounting for products held by a merchandiser. Manufacturers have three types of inventory. Number 1. Direct materials. This is the inventory the company purchases to make the products. For example, to make a dress, it purchases fabric, thread, and buttons. Number 2. Work in process. This inventory category includes all materials that have been partially but not completely made into sellable products. A work in process item could be a dress whose sleeves have not yet been sewn to the body of the dress. Number 3. Finished goods. Finished goods are all products that are completely assembled but not yet sold to a customer. So, our dresses are ready to leave the manufacturing plant as soon as a buyer puts in an order. Income statements are broken out into different sections. The main reason that items of revenue and expense are separated and reported in distinct sections is so the business owner can better use the income statement to make decisions and to isolate problems with the way the business is being run. Before you get into the meat of the matter, all the different types of revenues and expenses, you have to know how to prepare a heading for a financial statement. The first line of the heading is always the name of the company. The second line identifies the type of report, in this case income statement. The third line in an income statement indicates the period covered by the statement, for example, for the year ending December 31, 2020. Note that the date on the report is not the date when the report itself was prepared. In this section, we explain two revenue accounts that appear on an income statement: gross sales and other income. Number 1. Gross sales. The first account on the income statement is always gross sales, which is the amount of income the company brings in doing whatever it's in the business of doing. Some accountants refer to gross sales as gross receipts. Both names mean the same thing: revenue before reporting any deductions from revenue. Gross sales start with an implicit or written contract between a company and its customer. The contract states that an agreed-upon good or service is to be provided for a set amount of money. A company's gross sales revenue includes only transactions that relate to the purpose of the business. Financial accounting uses the accrual method of accounting, so a company can't record gross receipts unless that money is earned and realizable. Here's what these terms mean. For revenue to be earned, the job, whether it involves goods or services, has to be completed based upon the terms of the contract between the company and the customer. For revenue to be realizable means there is an expectation that the company performing the service or providing the goods will be paid. When might revenue not be realizable? If, after the job is complete but before the company is paid, a customer closes its doors and disappears or goes into bankruptcy, the revenue is no longer realizable. Number 2. Other income. You classify all other income the company brings in peripherally as other revenue or other income. Either name is fine. Your financial accounting textbook highlights 3 kinds of other income. Number 1. Interest, revenue a company earns from money on deposit. Number 2. Dividends, revenue a company earns on investments it owns, such as stock and other businesses. Number 3. Gain on disposal of an asset, revenue a company earns when it sells one of its assets, such as a car or desk, and makes money on the deal. The cost of goods sold on the income statement reflects all costs directly tied to any product a company sells. Be it a merchandiser or a manufacturing company. A service company will not have cost of goods sold line because it does not sell a tangible product. Because merchandisers sell products they purchase from manufacturers, their cost of goods sold are fairly easy to compute. That's because merchandisers have only one type of inventory to keep track of the goods they purchase for resale. As we noted earlier in the section, a manufacturer has several different types of inventory, so figuring its cost of goods sold is a little trickier. In this section, we talk about the easier cost of goods sold, merchandising, first, and then tackle the more difficult cost of goods sold of the manufacturing company. Number 1. Merchandising cost of goods sold. Figuring cost of goods sold for a merchandising company starts with beginning inventory, which is the merchandise the company has available for sale at the beginning of the month, in other words, the leftover inventory from the prior month. Next, you have to figure out the cost of purchases. To do so, you add together 2 items. Number 1, purchases, any new merchandise the company buys during the current month. Number 2, freight in, the shipping expense the business incurs in order to get the merchandise purchases from the manufacturer to its location. Your next step is to figure net purchases, which means the cost of purchases fewer contra purchases. Once again, contra accounts raise their ugly heads. 2 contra purchase accounts exist. Purchase discounts. This contra account reflects any discount a company receives because it pays a merchandise invoice early. It's the flip side of the contra revenue account, sales discount, looking at the same event from the eyes of the customer rather than the seller. Purchase returns and allowances. This contra account consists of items a merchandiser orders that it returns to the supplier. Items may be returned if an order arrives too late to use, arrives damaged, or doesn't contain what the company actually ordered. This account is the flip side of sales returns and allowances, looking at the same event from the side of the customer instead of the seller. Because purchases are an expense and normally carry a debit balance, a contra purchase expense will carry a credit balance. On the multiple-step income statement, gross profit is what's left over after you subtract the cost of goods sold from net sales. Basically, gross profit shows you how much money the company makes if it doesn't have any other expenses, such as office rent, salaries, and so on. Gross profit is very important in financial accounting because it gives the users of the financial statements a measurement upon which to compare this company to others. A company showing a higher gross profit than others in its industry will be more likely to attract investors as long as expenses other than cost of goods sold are kept in line. 2 principal categories of operating expenses show up on the income statement. Number 1, selling expenses, any expenses a company incurs to sell its goods or services to customers. Some examples are salaries and commissions paid to sales staff, advertising expenses, store supplies, and depreciation of a retail shop's furniture, equipment, and store fixtures. Number 2, general and administrative expenses, all expenses a company incurs to keep up the normal business operations. Some examples are office supplies, officer and office payroll, non-factory rent and utilities, and accounting and legal services. Depending on the amount of detail shown on the income statement, these 2 categories are often combined. You've gone through a lot of different income statement accounts so far in this course. Bet you never thought that making money could be so complicated. However, you are fast approaching the finish line where you find out if the company has made or lost money during the accounting period. Number 1, operating income. After you've totaled all your operating expenses, you subtract that figure from gross profit to figure your operating income. Number 2, other income and expenses. This line of the income statement also includes expenses that the company incurs other than costs associated with normal operations. Here are two types of expenses you typically see reflected on this line. Interest expense. This includes the cost of using borrowed funds for business operations, expansion, and cash flow. Loss on disposal of a fixed asset. Loss is the flip side of the coin. If a company sells an asset it no longer needs and loses money on the transaction, the loss reflects on the income statement as loss on disposal of fixed asset, or whatever the company decides to name the account. Number 3. Income from continuing operations before taxes. Adding other revenue and subtracting other expenses from operating income give you an income from continuing operations before taxes. Your financial accounting textbook may simply call this figure income before taxes. That's because if the company doesn't have any income or loss from discontinued operations, which are segments a company has disposed of, it's kind of overkill to add in the from continuing operations part. Number 4. Provision for income taxes. Before you figure the final total for net income or loss, you have to reduce income from continuing operations, or income before taxes, by subtracting a provision for the income tax the company will pay when it files tax returns. Number 5. Net income. If there are no unusual items on the income statement, such as discontinued operations, the income from continuing operations after taxes is called net income. That line on the income statement reflects all revenue less all expenses incurred in the production of that revenue. If expenses are more than revenue, the company has a net loss rather than net income. Earnings per share shows the spread of net income when you divvy it up among shares of stock outstanding, which means the stock has been issued and is in the hands of the investor. Potential investors in a corporation like to see this type of information so they can make educated investment decisions. If your motivation for buying stock in a corporation is to bring in some dividend income, you want to be able to compare what kind of dividends your top picks are paying their current investors. Before we get into the discussion of earnings per share, it's important to understand the two types of stock an investor may own in a corporation. Number 1. Common stock. People who own common stock are the ultimate owners of the corporation and have voting privileges. For example, common stockholders of record vote to elect the corporation's board of directors. Number 2. Preferred stock. This type of stock gives stockholders a claim to the corporation's assets. In case of liquidation, when the corporation shuts its doors and disposes of all its assets, the preferred stockholders are paid back for their ownership in the corporation first, and any leftovers go to the common stockholders.